What happens to the money I lost during a market correction? Let's get you that answer right now, right here. So here's the thing with a market correction. Assets are moving up, assets are moving down. It's a paper value that's a reflection of the total net worth of your portfolio, the total value, market value of your portfolio. You add the value of 100 shares of X company, 200 shares of Y company, and 500 shares of Z company. You multiply them, and that's the total portfolio value. Now, 4 or 5 months ago, maybe the market was higher, so maybe at that point, the shares were worth more. Today, they're worth less. Did that money evaporate? Did it disappear? Who got that money? This isn't a zero-sum game. Zero-sum game meaning somebody loses money, somebody gains money. The market cap of these companies has fallen. Therefore, they're now worth less. Therefore, your shares are now worth less. That doesn't mean that someone else gained in that trade. It quite simply means that you have less market value in your portfolio. Think of it this way. You own $1 million of a plumbing company. Somebody comes and makes you an offer for $1.2 million. Wow, that's $200,000 more than you think it's worth. However, you like your business, you don't want to sell, you love what you do, so you don't sell. You go to your bank asks you, what is your company worth? You put 1.2 million on it on your balance sheet, and therefore your net worth statement is now more, it's higher. 2 months later, somebody offers you 900 grand for that plumbing company. Did the 300 grand disappear? Did it simply evaporate? Is someone else $300,000 richer? No, your balance sheet, your net worth simply fell by 300 grand based on the value of a company being reduced. The same thing happens with publicly traded companies, except you have a portfolio of securities. You have a whole whack of companies from A to Z that are on your book or on your balance sheet. And whenever they go up or they go down on a day-to-day basis, your net worth improves or your net worth falls, but someone else is not getting richer. You quite simply have a lower market value or a lower net worth. Now, if you start selling your shares of your plumbing company for 900 grand, you have crystallized the value of your plumbing company. Therefore, it is only worth 900 grand. If you agree on a sale, a transaction at that price, that's what it's worth because you sold it. Same thing with your stock portfolio. So if you start liquidating positions at a loss, then you've actually lost that money. Don't get me wrong. Today, those shares are worth what the market is willing to pay for them. And that is a reflection of the current price on the exchange, on the securities exchange. That's what those companies are worth. You only reflect that value if you actually sell those companies at that price. If you keep the companies and wait for the market to come back, to bounce back, or for the valuations to increase or for profits to increase for that company, then you're not selling at a loss and you haven't crystallized a loss. There's a big difference between a paper loss and a crystallized loss. The paper loss, you can always expect and hope for it to come back and to recover. The crystallized loss is game over for that company. That's what you own. That's what you're locking in. That's what you're getting. The money doesn't disappear. It's simply a reduction on your balance sheet. Thanks, guys. I'm Rob Tetrault. Thanks for tuning in. I'll see you in the next video.